Thank you very much. Centuria is listed on the ASX. For those of you who don't know us, our code is CNI. We run two REITs, CMA, Centuria Metropolitan REIT, which is CMA, and the Centuria Industrial REIT, which is CIP. And both of them have got about $1 billion in them, and they're yielding about 7%, and they're A-REITs listed on the ASX. Centuria has been doing this for over 20 years, which is pretty important. You've got to look for that long-term track record. And we've actually completed about 38 funds, and we've returned over $2 billion worth of investors' capital to investors. So we've currently got about $2 billion in our unlisted property area, but we've returned $2 billion, and we've averaged about a 13% return over that time period. Now, we've had some exceptional returns, and Spring Street was probably one of our best, and obviously we've had some funds in the GFC where people had some pretty tough times. So it's been up and down over a period of time, but overall we've delivered some pretty strong returns. I'm going to talk about a bunch of things today, so I better get stuck into it. First of all, I just want to touch on residential, and we don't do much residential property. We developed one on Military Road in Mossman, where you drive along near the Mercedes-Benz dealer on the left. There's a new residential development for those of you who have driven past that. And that was a commercial property that we thought the best thing to do was knock it down and turn it into residential, and our investors did very well out of that. But typically we don't do a lot of residential, and there's been a lot of press about residential. Let's face it, we all own a house, so it's of interest to us. So I just wanted to touch a little bit on it and where we're up to. If we went back 12 months ago, things were looking pretty scary for residential property, and doomsayers like myself were predicting gloom and doom. And one of the reasons we were doing that was just that Australia had been such a top performer. So if you look up there on the chart on the left, you can see the orange countries. They're the top performing countries that delivered over 10% returns. And we're orange there in the middle. I think that's Iceland in the middle. It's been the one with the big 20% return. But also, if you look over a 5-year period, we're up in the top 10 as well. So we've had one of the strongest performing residential property markets in the world, which is a little bit crazy. If you've ever been to New York or Tokyo or Singapore or one of these places, you look around, there's not much land. We've got tons of land, so it kind of doesn't really add up from that perspective. But what's the concern about that is obviously prices have risen, and that can create a bubble in itself, but we're also a world leader in household debt, which is not a great title to own. We win everything at the Commonwealth Games, and we're winning household debt. So that's a bit of a concern. And also over on the right-hand side, you can see that our house prices have grown faster than incomes in most countries. So we've got a high house price to income ratio. So if you add up booming years, lots of debt, and a high price to income ratio, it's a bit of a cause for concern. Now, what has actually happened, if you break it down by states, it's not the same everywhere. Perth has been a very poor performer off the back of what we've seen in the resources, and Melbourne and Sydney have been very strong performers. Particularly Melbourne's had a massive run, and I don't know if you ever get down to the Melbourne CBD, but if you look out the window, there's just resi everywhere. So it's been a very strong performer, and as a result of these price rises, as prices rise and rents stay the same, your yield drops. And this is one of the big problems facing property today, residential property, is you've around a 3% yield in Sydney and Melbourne now. Now, we saw before you can buy government bonds at 2.7%. That's known as a risk-free rate. So when the yield on an investment gets down near the risk-free rate, it's cause for concern, because what people are saying is that this has got no risk. This is fantastic. And generally when that happens, we have a bit of a correction. So most professional fund managers price assets off the risk-free rate. So if it's a low-risk investment, it might be 1% above the government bond rate, maybe a Telstra bond or something like that. If it's a higher risk investment, you might get up to 8 or 9 or 10% return. So you've got to always keep this in the back of your mind. And this is one of the problems right now. If you don't think there's any growth, and your income's going to be the same as a government bond, why would you invest in residential? And that's a dilemma. Just looking at a chart here, and this is a great little chart that talks about where we are in Australia, and this was put together by JLL Research. And essentially what it's saying is pretty much everywhere around the country, we're in a situation where we're getting decelerating positive growth, and we're actually moving into decelerating negative growth. And you're seeing that around the country. There was an article in the Fin Review today. In fact, we're talking about 3 to 5% negative returns year to date they're looking at for Sydney and Melbourne now. So there's a few outliers. In, for example, Brisbane, the apartments have been very highly priced, and there's a lot of issues in Brisbane with residential apartments, but in housing, the market is still pretty good. Okay? Similar with Canberra, the housing market's a lot better than the apartment market. So we're moving into an oversupply issue, but what's actually happened that's curtailed that, and whilst I was doom and gloom 12 months ago, I've actually come back and I'm reasonably confident about where things are going now. And we're predicting a soft landing, and a soft landing may be a 5% correction. It seems to be diverted, and one of the big factors that has happened is the supply has really slowed down. The banks have just stopped lending to residential sector. So new approvals in Melbourne for 2018 are expected to be down 45% on 2017. Okay, Sydney's more like 33%. So we're actually seeing the banks pulling back the lending, and as a result, the new supply is slowing down. And I think this, combined with the fact that the Reserve Bank is keeping interest rates relatively low, is meaning that we're going to have a relatively soft landing in residential, as opposed to 12 months ago when the development chart was like this, and you extrapolate that, and that was going to lead to gloom and doom. It's obviously a big concern for the rest of the economy because the construction in residential has been a big driver in the Australian economy. We're yet to see the impact of the foreign investor surcharge. They're putting a 7% surcharge on foreign investors coming in from January 2019. This is going to slow people down. And one of the things we've got a bit concerned about is deposits off the plan apartments, and will they go through with a settlement? So people put down 10% deposit, they see the markets drop 15%, and they think, well, I'll just walk away because I'm losing money. And we've seen a little bit of that, and that's happened in Perth somewhat. And we've seen a few of those opportunities over there. We've actually stepped in as a lender and done a few deals off the back of that. So Resi's been a very strong performer. It's slowing down, the supply is slowing down, and what we need to see is we need to see prices flatten and rental yields grow, so we can get those yields back from 3% back up to about 5 or 6%, where people are going to go in and invest again. Now, it may actually happen that prices drop a little bit, and when they drop, your yield will increase as well, and that may solve the problem. Because I think when yields go from 3 to 5, there'll be a whole bunch of people who have been sitting on the sidelines saying that's too expensive, who are going to jump in and start buying it again. So there's a bit of comfort there. But are other asset classes equally expensive? And I'd argue that most asset classes around the world today are relatively expensive, and they're relatively expensive off the back of a period of very low interest rates. This is what asset classes have done for over the last 5 years. One thing to always look at, us fund managers can be pretty tricky, and we'll talk about 5-year returns. Over 5 years, we've done 100%. What you want to really look at, if you can, is get the rolling 12-month returns. Because if you've got 100% over the last 5 years, but 95% of it was delivered in the first week, it may not necessarily help you going forward. So a really good thing to always ask for and look at is these rolling 12-month returns, because that can give you an idea of the consistency of those returns and maybe a bit more about what you're likely to get going forward. So there's been some pretty strong returns across there in all the major asset classes. I like that chart because we're in retail property and we're winning, so that's a good chart. So just when you want to invest into non-residential property, which is what we're mostly about, you can obviously go out and buy an asset yourself. On the left-hand side, you can buy a syndicate, and a syndicate is we buy a building, we hold it for 5 years, we sell the building. We collect the rent, we give you the income on the way through, and that was an example of where 10 Spring Street was an example of that type of fund. These funds are fantastic because you're getting one building, you're getting a lot of certainty, you know what you're getting, and you're selling it at the end. However, on the flip side, you're not getting any diversification from a sector perspective or a region perspective. So I'd advise you to invest in multiple ones of those to get that diversification. On the right-hand side, you can go out and invest in the REITs on the stock exchange, Westfield, Stockland, GPT, Mirvac, all these types of companies, Centuria, and you can get liquidity and you can get bigger diversification, but as we saw some of the previous slides, you can get that. They've generally got a very high correlation to the share market, okay, so they can be a bit more volatile. All right, so lower volatility, more volatility, but greater liquidity and lower liquidity. And in the middle, we have these open-ended diversified funds, which is a fund that's like a share fund, but instead of investing in 20 or 30 shares, we invest in 20 or 30 properties. Okay, and we do those types of funds as well. So there's 3 of the ways you can get into those types of funds. At Centuria, we actually offer all 3 types of investments, and we're agnostic as to which way you go. You'll get the same type of property managed by the same people. It's just we're putting them in different pots because they suit different people's risk profiles and give you different diversification. I just want to touch on a couple of case studies because people want to know how you've gone. I was talking here last year about this building we were buying at the time, which is the Zenith Towers in Chatswood. If you go along the Pacific Highway at Chatswood, you'll see these 2 big towers, they're iconic towers. We bought those buildings just over 18 months ago. We bought them with BlackRock, who are the biggest fund manager in the world. They came in for half, we did the other half. We bought the building for just under $280 million. It's just been revalued at $339 million. So it's had a pretty good 18-month return. Investors who came in there at $1, it's now worth $1.30 is the unit price, and you've received 8% income on the way through. So you've received about, over the 18 months, you've received about a 42% return, which is very nice. And what's happened with Sydney is that in the commercial property sector, the metro line, we're all familiar with the metro line that's going into Sydney. They knocked over 20 buildings in the CBD and 19 buildings on the North Shore to build this metro line. I work in North Sydney. Across the ground's a big hole in the ground where they knocked over 3 office towers. That's been fantastic because a lot of properties have been taken out of the market, and also what's happened is a lot of properties have been converted to residential. So as a result, we're seeing rents rising, which is great for landlords. When we had Spring Street 2 years ago, we were doing rents at $600 a square metre. When we sold it, we were doing rents at $1,200 a square metre. Now that's just a supply and demand factor. As vacancies fall, we charge more rent and our investors make money. And what's happened is, as that's happened, it's flowed out along the train lines. So Chatswood, St Leonards, these sorts of areas have done exceptionally well. And that was a fund that's still running. We set it up as a 5-year fund. It's got about 3.5 years to go. And that's the type of thing we like to buy. We like big towers, we like iconic towers, and we like to buy the best building in that area if we can. We just bought one in Geelong. This just wrapped up just recently. We raised $74 million. We had $140 million in interest, so we had to scale some people back. So if you want to get into these things, you've got to get in pretty quickly because this one was filled in 2 weeks. This building's leased to the Transport and Accident Commission in Victoria, a Victorian state government-owned entity. They're there for another 10.3 years on their lease. They can't leave. Well, they can leave, but they've just got to pay us rent for 10.5 years. So it's a great building. It's a modern building. It's an iconic building in that area. The government moved a lot of their employees to Geelong as part of their urbanisation program, and they're going to be in this building forever. So we actually gear these funds at about 40% typically, and gearing can be your friend or your enemy. The thing about gearing is you want to have the cash flow that matches it. And if you're getting rent from the Victorian government for the next 10 years, we're pretty happy to gear that for a fixed rate. We fix the rate in for 5 years, and we're lending that at about 4% and receiving around 7% interest from the investor, from the tenant, I should say. So that was a nice little fund we've done recently. And then up in Brisbane, we did this one just over 12 months ago as well. This has got a just under 10-year lease to Energex, who are owned by the Queensland State Government. So once again, the state government's paying us rent. State governments don't go broke because they can tax us. And it's a very newish building. We raised $68 million to that building, and we geared that at about 43%. So 5-year term investment, collecting rent off the government, paying monthly income, starting off at 7%, growing to around 8% over the rental term, because as part of the leases, you get fixed rental increases each year. Okay, so these are great little investments for your self-managed super funds to give you that sort of ongoing return. We've got one happening right now. 60 Grenfell Street, Adelaide, is the headquarters of Adelaide and Bendigo Bank. It's a fantastic building. It's the best building in Adelaide. We were down there just recently, did a tour through the building. It's quite an amazing high-spec building. The floors are like walking through the Qantas lounge. People don't have offices anymore, they have breakout areas. It's an amazing building, and we're going to have a PDS out. We're in DD at the moment, and we'll have a PDS out, a product disclosure statement out on that in the next month or so. And for these types of investments, you just go to centuria.com.au, register your interest, and we put out about 3 of these a year. And when we put one out, we'll send you some information. And if you want to invest, you can fill out the forms or just give us a call and ask for more information. Just a little bit on the impact of rising interest rates. I don't think interest rates are going to rise sharply. If they do, you're going to lose money in all your growth investments. Okay? Rising interest rates are bad for everyone, including Mr. Trump, who I'm sure has lots of debt, allegedly with the Russians. So he's not going to be wanting interest rates to rise sharply, and I don't think any government in the world wants interest rates to rise sharply. However, I think interest rates inevitably will rise because they're so low, and if this does happen, then it will impact your returns because a lot of these funds are geared. That's why we tend to lock in our debt for 5 years. The higher quality assets will be less affected, and as the difference between property and bonds, if you buy a government bond, you're locking in your coupon rate for that period or a term deposit. The benefit with property is if you're getting rising interest rates, it's inevitably off the back of higher inflation, which is off the back of economic growth. If you're getting economic growth, you can charge more rent for your buildings, and you can actually get capital growth in your buildings. So direct property can benefit in an interest rate rising environment as long as it's not rising too sharply. I just wanted to finish off on some takeout lessons that I've picked up. I've been doing this for about 25 years now, and as I said, Centuria's been around for 20 years. I've seen some ups and downs. I saw the 93 property crash, which was 22% vacancies with oversupply. I saw the GFC, which was a credit crunch. And just some of my tips here is don't chase yields. People say to me, what do you think of this investment? First thing I say, what's it yielding? And they go, oh, it's yielding 12%. And I go, well, it's probably not a great building, it's probably not a great location, it probably doesn't have great tenants, and it's probably very highly geared. So don't chase yield. Have your punt money. I like having punt money. Depending on your risk profile, you might have 10 or 20% of your portfolio in your punt money, and if you want to throw that into a higher risk investment, then go for it. But don't be putting your life savings into these things. Research the manager. The next thing when people ask me about investment, I say, who's the manager? How long have they been doing this? What's their track record? How do they go in the down markets? How do they go in the up markets? Because obviously things aren't always going to be going up. Research the asset. It sounds pretty basic, but our strategy right now is the market has been very strong, so our strategy now is to buy good quality assets with good tenants, have the gearing conservative, and just really want to lock in that cash flow. So if we do have a recession in the next 5 years, and these types of buildings where the TAC or Energex or these types of tenants are just going to keep paying us rent, we'll keep paying distributions and we'll ride it through. Consider the gearing level. Does it match the asset quality? If you've got cash flow, if you've got a high quality asset, you can afford to carry some gearing. If you've got a lower quality asset, if you've got short-term cash flow, then you don't want to have too much gearing, because it's the cash flow that's a problem with the banks. When the banks step in, if you've got cash flow, you're pretty good. The structure, I've been involved in due diligence on Centuria and a number of these companies after the GFC that we look to buy. I've seen structure charts that you wouldn't believe. Everything owns something of everything else. There's arrows and diagrams going